as it is all set to become the third largest economy. We are here to discuss upon how cutting edge technology is disrupting businesses, and is this the change in technology sustainable? The financial market is the area where technology has disrupted traditional businesses in recent years. Companies such as Robinhood, PayPal have transformed their way we invest and transact money with their technology edge. However, the question that arises is whether this disruption is sustainable in the long run. Let's deep dive into this with Mr. Hitesh Javeri, SVP and head listed equities alternatives by Access Asset Management. Let me also take a moment to introduce Mr. Hitesh Javeri. Hitesh Javeri joined Access Asset Management Company in 2000. He is responsible for managing the Access BMS portfolio along with relevant Category 3 AIF strategies. Hitesh has over 25 years of experience in portfolio management, banking, and equity research. Prior to joining Access Asset Management Company, he served as head of investment in the PMS business at Aditya Birla Mutual Fund. Hitesh has also worked with Inam Asset Management as executive director and portfolio manager and Edelweiss Capital as senior VP. Hitesh has contributed his research to a book who was authored by two Harvard Business School professors, namely Wall Street Research Past, Present, and Future, co-authored by, co-authored by Professor Boris Groyberg and Paul Hurley, published by Stanford Press. Access Asset Management Company has come a long way from launching their first alternative product in 2017. They aim to provide our investors with portfolio diversification beyond traditional avenues. As an investment manager, Access Asset Management Company has always maintained an unwavering focus on quality investing and stringent risk management. Their aim is to invest with utmost transparency and offer a superior investor experience along the way. Now I'm handing over the mic to Mr. Vikas Agrawal, who will in turn be handing over the mic to Mr. Hitesh Javeri.
Yeah, thank you, Pragya. Hitesh ji, can you hear me?
I can hear you well.
Okay, great. So firstly, thank you so much for accepting our request and taking the time out from your busy schedule and joining this AIF and PMS Conclave 102.
Lovely to be here. Rather excited that I could join you all today.
Right. So Hitesh ji, as we discussed, when we talk about India to become third largest economy in the world, we talk about moving from $2.5–3 trillion to $5 trillion, and now people are talking about $10 trillion size. And the topic is India is going to be Sone ki chidiya once again. But the question is that we are also witnessing huge amount of disruption coming in through various sources and channels and ways of doing businesses. So what we're going to do is, if you can take us through your thought process and share your valuable wisdom with us in terms of the GDP, the contribution where it is coming from, and then we can, my submission is if you can spare some time and talk about these receptions also, which will enlighten all our investors to know more about where are we headed.
Sure, sounds wonderful. Happy to get started with that. Thanks, Pragya, for the kind introduction, and thanks, Vikas, for the invitation, and good afternoon to all the delegates. So where we here at Access are rather excited about the journey that we have undertaken, and excited about where we think the pattern in which the Indian economy is going to grow, India's GDP is going to grow, and then what should the investors be doing? And in this conversation, I'm also going to cover what Vikas mentioned is that which are the industries that are getting disrupted, and inside of that what are the growth areas, what are the opportunities, and then what can be the pitfalls and so on. So I will just try and we can share the presentation. Okay, so I hope all of you can see the slides clearly, and yeah, we'll just need some help in changing the slides.
On that, and you will be able to change the slides the way you do it normally.
Yeah, sure. Right.
Yeah.
So, right. Well, so this has been a very interesting decade for all of us. This is all of us are lucky in one particular sense that in this decade, India has already crossed 3 trillion GDP. In this decade, we are going to cross 4 and 5 trillion GDP, and in this decade, we will most likely, cross 6 trillion by 2030. So this is a very exciting decade, and this is the one of those rare events where we are going to be crossing so many landmarks in this decade. Now, what is happening is that when we were doing this study, that when India, for example, crossed the GDP for the first time of 1 trillion in 2006, and then 2007, and then 2 trillion in 2016. What caused the this growth to take place, and of course going to 3 trillion in 2022? What was the composition of the incremental GDP growth? Now, it was very interesting. We have always been told, and many research over the last many years, if you go back, more than 5-7 years ago and so on, the research was mainly talking about that India is, per capita, lower usage of everything we use, low per capita cement, per capita FMCG, per capita consumption of pick an item in India was low versus the regional Asian average, forget the world average. And therefore, as we consume more and more, India GDP is going to grow, and so on. While that is true, but the reality was that India's GDP actually grew more on account of industries that are depend on innovation, technology, IP, and sciences. Now, that is something that has not come out sufficiently in reality. Now, whatever that you are looking at your screen, it's exactly the same thing here in a graphic form for us to get more appreciation, which is that as you can see toward the right of the screen, we crossed 3 trillion, and we took 6 years to add that incremental trillion, and then before that roughly 10 years and so on. So when you start with 2006 and go from 2 to 3, and then we looked at then for a number of forecasts from various industry sources, such as from NASCO McKinsey, Frost and Sullivan for chemical, and the BCG and Bain for the pharma industry and so on. Now, it was very interesting that, for example, actually, I do recall going as a young professional to Delhi for one of the first NASCO McKinsey reports in 1998 or so, saying that Indian IT industry, which was a $3 billion industry at that time, that it will become $50 billion industry in 2007. And there was a NASCO McKinsey report again in 2002 saying this industry, which is $11 billion in number, will become $60 billion in 2010. 2005 report saying that as versus $21 billion then, that we will become $150 billion by 2015. Turns out we were very close all the 3 times on these numbers, and as versus achieving $145 billion. The revised forecast is that India is going to be between 350 to $400 billion in terms of the industry size. And NASCOM had its annual conference last month, and it said that India is already $245 billion. As much as you see the 350 to $400 billion of forecast on your screen, the achieved number already is $245 million as per the NASCOM numbers. So, in fact, if you compare the number of roughly around $145 billion in 2015 versus the GDP level then you actually get an appreciation that what contributed to India's incremental GDP growth. As also you would see in the pharma industry, for example, for low single digit size to become $42 billion industry by 2020, a growth of 10x. And as versus the current number, the industry association in conjunction with consulting firms gave out reports saying that the industry's goal now is to drive towards $130 billion in revenue. It does help that during this period, what has happened is that Indian industry has gone from close to.
Hitesh, can you hear me? Sorry to interrupt. Can you hear me?
I can hear you well.
Yeah. So there is a request which has come from audience. Can you put this slide as full slide view? Yeah.
Yes.
And
is it better?
Yeah. Can you zoom this out a bit, like maybe 100% if you can make it from there on your right? Yeah. On the top. Yes.
Sure.
Yeah.
Did it help?
Yeah. Much better. Thank you.
Sure. Thank you. Yeah, thanks for pointing that out. Appreciate it. So, so again, in case of pharma industry, as we would have crossed reached very close to $50 billion versus the actual numbers of 2020, and the forecast of going to the goal of going towards 130. Similarly, India makes 80,000 different kind of chemicals. We were less than $30 billion industry in 2000, and that industry has become 6x since then. And again, the industry is striving to double this number, as we speak, over the next 3 to 4 years from the starting base point of 2021. um, Another dimension to our conversation, talking about how the incremental GDP growth in India over the last 20 years or so has come from technology, innovation, IP, and sciences, is also a conversation about automotive. In reality, the government of India has made it more stringent in terms of emission norms, in terms of ethanol blending, in terms of the vehicles becoming more and more sophisticated in terms of safety parameter and so on, and of course the drive towards EV. It was a long time ago. Our great grandfathers and witnessed something extraordinary in 1910 and 1915, that for the first time, or 1905 and so on, for the first time in human history, that the vehicles are drawn not by animals but by the internal combustion engines. And what all of us are going to witness in our lifetime is a serious transition taking place away from the ICE vehicles and becoming EV vehicles. Already we have the whole plethora of vehicles in terms of electric vehicles, the hybrid vehicles, the LNG driven vehicles, the CNG driven vehicles, talking about hydrogen vehicles, which are not very far in the future as well. So if you consider the dynamism of all this, one thing is very clear, that as India had lagged behind in the past with regard to tech driven industry taking root in the country, that in fact is no longer the case. In fact, it has not been a case for a while now. Just that I would point out to this audience that this is something that we have really heard less about what is driving India's GDP growth. And to do justice to the topic that the organizers have shared with me today, which is that where are the disruptions coming from? As you see, in reality, India has disrupted the legacy business models of IT already for almost 25 years now, with incrementally a lot more R&D taking place in India. We already disrupted, of course, the whole para 4 world and the whole first to file world long time ago by being able to manufacture generic medicines at lower cost and very high quality FDA approved plants and so on and so forth. So that has always, India has already passed through a phase where we pass the early test. We are able to make go higher in the curve of complexity in terms of our ability to make IP based, science based products, created high quality business models around it, and created value. And as you would imagine, what the IT stocks have done over the last 15-20 years, India's pharma industry, India's specialty chemical industry. In my younger years, this used to be specialty chemical used to be single digit PE stocks. Now they rival in terms of PE multiples. They're not very far from FMCG multiples, by the way, in many of them. Um, so our view is that for investors to really focus when India is going to grow from 3 to 4 and $4 to $5 trillion. And by the way, this is not too far in the future. We are in FY24. The forecast is about FY28. So this is not pie in the sky conversation. Already investors have the opportunity to continue to ride on this wave, and as it gets bigger, to participate and work to outperform in their portfolios. Moving on, technologies have been around for a while. It's not that technologies, from the R&D, inside of the R&D stables, inside of the R&D places, that they were not around. What is changing is you need not one ingredient, but you need a few pillars for this growth to take place. One is, of course, the markets and marketable R&D already in place, but we need entrepreneurs. We need entrepreneurs to mind this. In this regard, India has been lucky. India has been a, if you will, a high quality talent management factory. In fact, I would argue even for the world. Look at the tech space in the US, and number of Indian CEOs who have made it, but also the middle management and the upper middle management, and of course in India itself, the quality of entrepreneurship. If anything, the quality of the entrepreneurship, and to support that, we also already have in place another source of growth for India, which is the growth capital or the risk capital available for to cause disruption to happen. Now, what we are talking about here is that, if you are bright, you don't need too much capital. You can create a Zomato. If you are bright enough, you can create Policy Bazaar, and you can create Nykaa, and you can create a Misho, and you can create a Swiggy, and you can virtually create anything that you would open up your mobile phone and see what apps you have. That is what bright people have created in most cases without having the without having much of startup capital. Today, if you are in this ideas driven, IP driven economy, it is your ability to disrupt the business, to transform certain industries, that is what is counted. And once you are able to kind of show this and convince the risk capital providers, then the business are ready and then able to challenge the status quo, which is again remarkable. And fourth pillar, the way we see it, is also very crucial, is the government support and the conducive policy environment. We have seen that the developed economies, there have always been much more conducive for private entrepreneurs to take risk and then provide the high quality infrastructure. In India's case, when was the last time a government will update you what is India's ranking on ease of doing business? What is India's improvement on the Global Innovation Index? How many people are connected, with their Aadhaar card and their PAN numbers and their Jandan accounts and so on? Suddenly, our growth of addressable market for most categories has gone up, and people ability to consume, because therefore the access to credit and so on, ability to consume has grown up higher. And then when you put all of this four together, we are in, I would argue, one of the most dynamic economies in the world. If you would notice what has happened yesterday, and just yesterday, is that IMF, for the maybe fourth time in the last 6 months or so, has cut down the world GDP growth, and India's number again are the highest in the G20 economies. We are forecast to grow at 5.9% for FY24 and 6.2% after that. Higher than China and meaningfully higher than most other economies. And I would argue that what is allowing India to do that is just the dynamism, and also the fact that incrementally our GDP growth, just to repeat myself, has come a lot from tech-driven, IP-driven, innovation-driven industries. In addition to the industry that I showed you, also internet and e-commerce, also mobile, also the in the automotive and mobility, of course, and the omnichannel retail. The way we see it is that the growth that is going to take place is incrementally more and more going to be driven by also the ideas which are also in the anvil. So, in fact, of the number of a few incremental things that we're looking at, that the manner in which Indian pharma companies have embarked on M&A at individual levels, the number of M&A that is taking place in IT, and in what area are they taking place, where the PE money going, where is incremental the VC money going. We were worried, there was a lot of press about this 3 years ago and 5 years ago, that what is fintech is going to do to banking in India. And what is the reality is that, banks have met those challenges. Banks, incidentally, by the way, have been one of the larger acquirers of many of the fintech plays, absorbing their technologies and transform themselves and becoming nimble. In the reality, by the way, if you were to look at, let's say, a given bank, large private sector bank or largest NBFC's presentations, you would find that almost 10% of the slides around technology inside of a banking or NBFC presentation, in terms of what was done to create the APIs, industry relevant APIs, what was done for mastering AI and ML, to do the underwriting better, what was done to make the app experience better, to have the digital experience better, to the cross sell better, and so on. And this is how we think that India is going to become more and more innovation driven economy, and driving sustainable growth. Because how are we doing on time?
Yeah, so we have few minutes left out. You wish to
Sure.
conclude your slide, you can do so.
Sure. So in couple of minutes, so as much as I will not necessarily go into each of the deep dive about banking and fintech, but the reality is that in each of the categories in banking and fintech and in tech services and industry, that seven industries that we are focusing on highlighting, as versus again in chemistry, I we are no longer focused on low value added, low less process sophistication, low fewer number of processes kind of chemistry, no longer those bulk chemical and soda ash and so on, as versus that a lot more complex work. Pick an industry, and we should be able to demonstrate that how India is getting more and more sophisticated, and then driving high quality GDP growth, and that is what is giving us the confidence. I mean, if you were just to pick another example in omni-channel retail, because as we speak about these seven industries, and as I conclude in a minute or two, um,
Right.
what has happened as well is, as consumers, just to talk about combine the effect of the mobile revolution, the banking and fintech, the omni-channel retail and internet commerce. If I had to combine, how has our behavior changed? If you were somebody like me till 4 to 5 months ago, you would have probably Amazon Fresh as an app on your mobile. You will order something and receive whatever you purchased in a day, and I would be happy that the hassle is a lot lesser. And then however our behavior changed in last few months, we are going to likes of the Dinzos or Instamart and so on, and what we're getting in a day we are getting in half an hour at our doorstep. And if I would argue that this actually kind of combines a number of things that we discussed today, and that is what has changed our
So,
behavior
hi Gautam sir.
fundamentally,
I've
structurally,
read your
in
book,
the
The
last
Joys
year.
of
With
Compounding,
that,
and it's
because
really
I'm happy to
amazing. So, I have
pause.
a question for you.
Sure, thank
So,
you.
how do you say
So
that
one question from my
humidity
end, Hitesh,
increases
is
the
that
savings
Yes.
and
I
not
mean
the
the
income?
question
I
which
would
has
like to
come
know that. I'm
in.
just curious.
So
Yes.
what can go wrong?
The
Like
most
what kind of
effective way
disruption
to
you
increase
see
your
which can come on
savings
our
is not to
way,
increase your income. It is to
and this
increase your
can
humility,
delay
because
in
many
terms of a
of
growth rate,
us
or maybe
we fall prey
becoming
to what is
big
known as
$5 trillion
lifestyle creep.
economy
As our
you
incomes
talked
go up,
about in
we
five
adjust
to
our
eight
standard of
years
living
ago.
accordingly, and therefore there is
I
no
It
change in our
won't
savings
doesn't
level
work like
even
that,
after
because in
increasing
the
our
sense
income
that some
level.
new
So
innovation comes and
to
therefore we do not grow.
build up your savings
So,
over
but
time,
the reality is
increase your
that different
humility.
kind of
Not
innovations comes, and there are
what is
companies,
important is
there
not to
are
fall prey to these
there are
comparison
say
games
for
and trying
example,
to
if
compete with the
Nika
Jonases.
is able to
What's important is to
synthesize
play your own
a
game,
number of
because
technologies,
life at the end of
sure
the
it
day is
will
a single
disrupt
player
some of
game.
the other
You have
businesses
to please
existing,
play the game
beauty
which
and
is aligned
personal,
with your
the fashion
personal
business and
value
so on.
system. No need to
But then
impress
the
anyone
value
else.
migration will happen to
Right.
like one, right?
So next
Or
question.
take
Yeah.
Hi
case of
Gautam sir,
Make My
Purvanshi this
Trip.
side. I
Now
read
it
your
is going
book,
to
The
become
Joys of
intermediary,
The
and
Joys
then
of
our ticket
Compounding.
booking
My
experience.
question is from
So
chapter number
there will be some
23,
impact on
and
the
my
other side,
question
but
is how
there
does
is a
growing
winner. So
firms
it's
with
not that
excess returns are more valuable
the
than NPV?
GDP growth reduces because of it. What happens is that it is contributed by newer incremental different set of players as versus the existing one, but it doesn't bring down the GDP growth.
Okay, okay, great.
As
With
by the way,
that,
if I were to, sorry, I mean just to finish. So in fact, the if I we pointed out the seven industries that had driven the most of the growth over the last 20 years, and what the reality therein, right? So when Indian IT industry comes and disrupts, well, it brings in growth and new GDP growth opportunities, or banking and fintech and so on. Where as versus, for example, PSU banks, it is the private sector banks that will do more of the value creation, but it does not bring it down. On the contrary, innovation brings in new players who create more value, and that's how the enhancement takes place.
okay, so with that, we'll conclude the session here. And thank you so much, Hitesh, for taking the time out, joining this session, and enlightening us with your thought process. Thank you.
My pleasure. Lovely to be here. Thank you very much.
Thank you.